Hello, everyone. Welcome to the weekly roundup. Today we will cover interest rates, policy shifts, and market sentiments. Hello, Ben.
Hey, Eva.
How's it downtown?
It's rainy, just like everywhere. A little bit slow going around here.
Okay, let's enjoy the rain. Okay, I'm gonna get right into it. The U.S. Federal Reserve Chair, Jerome Powell, he spoke
Mhm.
earlier this week on interest rates and the economy. What key signals did he send, and what should investors expect in terms of, future interest rates decisions?
So thank you. Yeah, it's a good question. I think Powell's generally since the meeting, even last week, have been talking about the changing environment with jobs and some of the challenges with tariffs and such. And so generally looks like we're heading towards lower rates still, particularly in the US. And the start of the week here was something like 91% likely that they're going to cut again in October. I don't think anything that he said or that happened this week is going to change that. We had some jobless numbers, which we can comment on as well. But generally, most of the things that he's been talking about is concerned about the economy slowing and unemployment rising. Has been more of his concern than inflation, which is quite a policy change from how they were focused on earlier this year.
Okay. President Donald Trump announced plans to impose a $100,000 fee on H-1B visas. How significant could this move be? What impacts will this have on companies, especially in the tech and finance sectors? These sectors rely heavily on global talent, so how could this affect them?
Well, materially, the top five tech companies that have applied for these visas are Amazon, Tata, Microsoft, Meta, Apple. I think Google's right below that if we were to go past the five. So it is the big tech companies. Seems strange. Amazon's 10,000 plus employees on that in the US. So it is pretty material if they go ahead with it. Not sure the tactic or the thinking around that. Again, then if you look at the finance as you referenced, so JP Morgan, Fidelity, Goldman are the top three that have a negative impact from it. So it is a material attack. We'll call it a tax. I mean, there's nothing else than that. Is it be a tax on these companies? So I think this has been the biggest thing that we've seen from Trump is that
Yeah,
he'll do something that's progressive for the economy, and then he'll do something that's counterintuitive that is going to slow the economy. And so that's this ebb and flow that we've been seeing from all along. And this is just another perspective there. Markets didn't really have a material impact from it. I thought it would have a bigger play on that. We saw Oracle down a little bit today, but nothing specifically related to that, where I thought it would have a bigger impact given the number of employees it could potentially impact and the amount of money it could cost these companies.
absolutely. It almost
Yeah.
seems like the market is like close your eyes, close your ears, and just do your thing. You
Totally.
would expect actually a reaction on that news. Speaking on the equities markets, we're hitting fresh highs, showing strong momentum. This is again despite economic and political challenges. Is this rally supported by fundamentals or is it driven by other forces? Maybe fear of missing out or liquidity. I mean, what vulnerabilities should investors keep in mind? Valuations are stretched at this point.
Yeah, so you ask a great question, a great point. FOMO, YOLO, whatever you want. Everybody's afraid of losing all them not being there for the party. So yeah, look, I'm a fundamentalist at heart, and I think you are as well. We've spoken about this, and so as we continue to creep, and as I've continued to learn over the years, right now, and at least for the last decade, the market has not cared about fundamentals in any way, shape, or form. So market appreciation or depreciation has been driven off of two things, economic activity, and the other is money supply or financial liquidity, however you want to look at it. And so where I look at it and we see, S&P 23 times earnings, whatever. If you look at forward earnings too, it's 23, 24 times forward earnings. And if you look at CAPE, which is the Schiller index, which is the one that Buffett uses, this is up around 40, like historic highs. Um, so the answer is yeah, the fundamentals, if fundamentals matter again, then that's a crack we need to think about. But right now it's been money supply and economic activity. And we're seeing M2 accelerate quite materially in the past month. And so I think this is one of the themes we've been talking about for the past year or so. And so I think that continues to be the case. I don't think it's forever, though, to your point. And we need to be conscious of this and pay attention to what we should do with investments. But right now, that's what's been driving the markets. And where you look for the off ramp, I think, is one of the big questions that's outstanding today. Looks like probably economic activity, money supply starts to slow sometime mid next year. And markets start to anticipate that at some point. I don't think they do yet, but I think in my bigger picture thinking, mid next year is when I could see things potentially start to go in the other direction.
Okay, thanks.
Mm.
Let's see the charts.
Good.
Yes, all good.
Okay, perfect. So we are recording this on Thursday, September 25th. Actually, I have a typo though. It's September 25th at 11 a.m. We're recording a little bit earlier today. So anything that happens after now, we'll comment on in detail next week. Obviously, if you have any questions between now and then, certainly as always, please feel free to reach out to us. Have a call, book a meeting. Happy to give you an update on the portfolios and or what's going on in the markets in the world. So this is a little around your question that led us off, Eva, was what's happening with rates and what do we see happening for the longer term? And so it says, this comment says, will June Hawks shift all the way to 3 cuts this year? Markets seem to be suggesting that. So if we look at forward guidance and there is a tool, if you're interested, it's called fedwatchtool.com. So if you want to go there, it gives you all forward pricing on where they think rates are going. Pretty good, pretty accurate, a great place if you're interested in tracking it. But just looking at the visual here, we do anticipate another 2 cuts, maybe 150 and or 225s. Right now, it looks like we're suggesting 225s. And then longer term, if you look at where rates go, so this is continuing down. I'd anticipate if we do get a crack in the economy mid next year, then this probably slows down quicker. However, if you look at the dot plot here, the majority are heading towards 3 and below, which is a pretty material drop from where we are today. Then tariffs. So while the H1 visa is not necessarily a tariff per se, certainly is acting a bit like a tax. And so US tariff rates are picking back up again in this case. And so as we got into earlier on this year, we had kind of the initial jumps, fentanyl, aluminum, steel, autos, reciprocal tariffs, back to electronics, deal with the UK. Looks like agreement came into place in May. Markets started to accelerate from there. Now we've seen markets at elevated levels, to your point, and now we're seeing them start to crank up again here. So steel, aluminum, Vietnam, Japan, South Korea, Brazil, all these tariffs started to kick back up. Now this H1 visa, which I would fall into that bucket, tax tariff environment. So a bit of that, as I say, ebb and flow where markets did okay, then negative news came in, April panic, markets sold off. Now markets are doing okay, and we're swinging back up to the other side where he feels he can attack. And provide some aggression maybe on tax or tariffs. And so this will, I think, will be a key piece because the market's a bit complacent right now. And so I think we'll have to be conscious of what that could mean. On top of this, this is the US greenback. So what's going on with the US dollar? And so this is from our economics team. Effectively, it says the greenback continues to cheapen. And so this is against the kind of the 24 biggest currencies in the world. I look at this in a multitude of ways. And so if we remember to 2022, excuse me, 2022 was a quite a challenging year from a environment where we saw the opposite happen, where the only thing that went up was the US dollar and every other asset class went down until we got to near the end of the year. And then we saw US dollar trend sideways and then markets started to pick up in 23, 24. And now we're coming down the other side of this again, where we're seeing, financial conditions are easing, markets are doing well, US dollars going down. This is, I think, a key piece to pay attention to, where the trend is that the US dollar continues to weaken. But if we do see any cracks in this, where we saw, a pickup in the US dollar, maybe a risk off environment for something that we don't see happening yet, but maybe there is something, when you've had such a hard, sharp trend to the downside, particularly for the US dollar, you could get a mean reversion where you get a bump in the US dollar that puts pressure on risk assets, which is equities, that puts pressure on the emerging markets, international markets. These are some of the things that have run quite well this year. So oftentimes I get the question of what should I pay attention to? US dollar is a key thing that we should pay attention to. As always, one of the great things I like to do is look at markets in the world, see what's going on. And, one of the challenges I've said all of this year is where do you go? And so if you have had some winners, which it's hard to not have some winners, but if you've had some winners this year, then where would you be recycling those money to? Where would you be selling something, taking a profit and buying, going somewhere else? This is a great research piece, and Argus does a great job, which is one of our partners, giving an idea of where the potential opportunities are. This is just how I would look at certain things. And this little box here within their reports is called Key Statistics. And Key Statistics tends to give you a great little snapshot to think about. Maybe there's some opportunities here. So even in the mix where I say maybe the market's extended with valuations, fundamentals don't matter, the other side of me says, okay, maybe there's opportunities in the fundamentals where we could see a swing back up to the upside. So this is a view on Baxter International, obviously a pharma company, and an area that's been really beat up with all the negative news in the world. But if we look at it today, pretty good company, $22, $23 trading around. Target upside over the next year is 32. So pretty nice move. Valuations look good. Payouts look good. Trading at 9 times forward earnings, pretty excellent. And if we get a shift back to some of these consumer staples, this is a potentially a good company to consider at that point. But it's a great snapshot, really gives you a sense of how I think about when I'm looking at companies to potentially switch assets into that have done well, which is you want to sell the winners and buy the losers that become winners. And that's, I think, how you cycle and manage portfolios over time, or at least that's how I do it. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. If you have any questions, certainly feel free to reach out to your advisor or to myself. Not everything is appropriate for every risk tolerance, so please feel free to have a discussion and think about risk when you're investing your money in the markets.
Great. Thank you, Ben.
You're welcome.
So, what's on the agenda for next week?
Yeah, so we're heading towards at least the end of September, which is hard to believe. And as we start to head towards end of September, I think we talked about this close to a month ago where we said, maybe September is going to be a rocky month that we need to worry about because it has been
Yep.
historically. So we are trying to be patient and keep our fingers crossed as we head towards the end of this month, which is next Wednesday. So we'd be paying attention to that. And get into October. October, again, historically, there's been periods of time where we've had some choppiness to pay attention to. But really, as I referenced briefly in the charts there, the market is quite complacent. Volatility is quite low. Trends have continued for quite some time, and that tends to be the most precarious time in the markets. And so I'd be watching quite closely for some cracks. And so, as I mentioned, US dollar, bond yields, gold. Those would probably be the three things that I'd key in on here in the next 4 or 5 days to pay attention to. If there's a crack in any of those areas, then it's something to say, okay, maybe we need to be a bit more cautious and a bit more aggressive on the selling. And those would be the three things that I'd be focused on.
Great. Perfect. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video, as well as in your inbox if you are subscribed. For our clients, please also reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you for listening and enjoy the rest of your day. Bye.
Thanks. Take care.